All right, everybody, welcome back to session number 3. So far we've covered acquisitions and we've covered analysis. Well, today we have a special guest. So Charles Seaman with Cashflow Champs, very good friend of mine. We've done a little strategic partnering on a deal in Charlotte once. We didn't end up getting the property. It was not quite as advertised. Um, but he has agreed to come on and talk today about asset management, project management, your business plan, and then exiting the deal. So I'm going to back him up today. Charles is going to do all the teaching, so you're in for a little bit of a treat. He'll invite me in when he feels he needs my input on things. As usual for everybody, you are absolutely welcome to put your contact information in the chat box. Charles is going to put his contact information in there as well. And feel free to network. Again, the only thing I ask is that you do not put anything deal specific into the chat. I will remove it. A second time, I will remove you. I haven't had to do that. So hopefully here on day 3, we continue to go the way we've been going. So we're looking at another 2 hours today, maybe a little over, maybe a little less. It just depends on how long it takes Charles to get through these slides. So Charles is a syndicator. He is a principal of Cashflow Champs. And you guys own what, 7 properties now?
Yeah, so with the cash flow chef brand, we have 2, but collectively between us, we have 21 properties and about 2,700 units.
Yeah. So Charles knows what he's doing. He's got a great asset management team in place. I've met his operating partner and his property management consultant. She's amazing. And they do a wonderful job. So one of the things I do want to mention is, and Charles, if you want to put the registration link to it, you can. Every Saturday, Charles has an underwriting workshop that he does where he takes an offering memorandum of a deal that is actually on market and they analyze that deal. Starts what, 3 or 4 o'clock Eastern time?
Yeah, 4 o'clock Eastern, and usually goes anywhere from 2 to 3 hours typically.
So you guys feel free to do that. He doesn't charge anything for that workshop. So with that said, I'm going to hand it over to Mr. Seaman.
David, thanks for the introduction. And we want to give everybody a warm welcome here. Strategic Acquisition Workshop Day 3 Operations. So we're going to be talking about a few different things today. For those of you who attended the previous 2 days, here's a recap of what was discussed in the acquisition and the analysis phases. And today we're going to be focusing on operations, which you can see is highlighted in green down below. We have asset management, project management, and exiting the deal. So we'll be focusing the bulk of our time on those 3 items today. So what are we going to cover today? Well, let's do a quick rundown of what you can expect. So in operations, we'll be talking about asset management. We'll be talking about the business plan. Keep in mind, it's always important to have a plan and to do the best you can to execute it, even when pivots are needed. Project management, exiting the deal, and action steps. So the most important thing with anything is always going to be the action you take after. So keep in mind, you do want to soak it in, but then you want to figure out where you can take action that's going to have a meaningful impact on you. So the first thing we'll start with is asset management. So asset management is the practice of increasing total wealth over time by acquiring, maintaining, and trading investments that have the potential to grow in value. So keep in mind, within our space, oftentimes there's confusion between property management and asset management, and they are 2 different, very distinct things. The asset manager is the one who's in charge of steering the ship. So they're going to be setting the direction for the investment, and the property manager is going to be the one who's in charge of executing that direction. So in most cases, you won't see the asset manager doing day-to-day activities like leasing or collections or dispatching work orders. Yes, sometimes you might, depending on the property and the size of the team involved, but in many cases, you probably won't see that. Property management is going to be those tasks. So that's going to be knocking on doors and calling tenants to collect rents. It's going to be uh, filling vacant units. It's going to be making sure the tenants are satisfied. So the asset manager's job is to manage the property manager and make sure that the investment is meeting the plan that's proposed. So let's talk a little bit about the team that you're going to need to be successful here. So one thing you need is communications. You know, what type of communications are you going to have and what frequency? So one thing we do at the beginning of all of our deals is we usually have a kickoff meeting with the property management company. And the reason we do that is because one of the things you learn being in this business is it's very easy for two people or two parties to have very different expectations of the same deal. And if you don't clearly communicate what the expectation is, then they may not be delivering on the expectation, but in all fairness, they didn't really know what the expectation was. So you as the asset manager, the owner, whichever role it may be, needs to be the one setting the course and letting them know what it is that you expect of them. And that's got to be set from the beginning, so that way they can stand a reasonable chance of actually delivering on it. Financial strength. So your CPA, your lead sponsor. So your accountant's going to be somebody who's going to, really dive into the numbers. They're going to help you with some tax planning. They're going to help you with getting a good feel for the, just the overall financial strength of the property. The lead sponsor is the person who's going to be tasked with many times signing on the loan. There'll be somebody who, if you're syndicating, will probably be the one in the offering docs listed as the contact person for all prospective investors to reach out to, and ultimately the one who's taking the burden and responsibility for the success or failure of the opportunity. Usually, to become a lead sponsor, you need to have a combination of liquidity, net worth, and experience, because most times that's what lenders are going to expect, and that's what you'll really need to be in that spot. So property updates, your asset manager and project manager. So, again, it's all about communication and expectations. You need to set goals for what that's going to look like. So with most of our recent acquisitions, we're doing bi-weekly meetings with our property management company. We do those to get status updates on KPIs of the property. We go through things like how many leads are coming in, how many are we converting, what have we collected, what's outstanding. So we want to get a good understanding of the overall health of the property. We want to make sure it's healthy, because if it's not healthy, that can quickly become a problem. And we do a monthly meeting with our asset manager, because what we do is then we dive into things a little bit further, and we dive into things that we may not necessarily want the property management company on. So we dive into things that, maybe issues the property's having. So if we projected a certain rent in our underwriting, but now we see that we're having trouble actually hitting that rent, do we need to adjust course? Do we have more vacant units than we want? And maybe we need to figure out a different strategy to go out there and fill these units. So that's where the asset management is going to come in handy, is understanding the major points that are going to really make the property succeed or fail, and understanding when and where you need to pivot. So market updates, acquisitions, and strategic partners. So you need to have the right players on your team. It's like if you have a baseball team, you don't need 9 shortstops. If you have 9 shortstops, the guy playing center field probably isn't going to do too good. So you need the right people to fill different positions on your team. And that's really going to be key as you're building this out. Acquisition updates from the acquisitions manager. So that's going to be, somebody you're communicating with on a regular basis about any incoming leads that have potential, and also ones that go through fruition, because a lot of times you'll see the acquisitions manager in contact with the asset manager to make sure that the plan's actually moving ahead as projected. And investor updates. If you're not using your own capital, you do have a fiduciary responsibility to any investors that come in, and you have to give them periodic updates. So most times when you present an investment opportunity to them, you're going to state what the frequency of those updates will be. You could tell them there's going to be monthly reports, there's going to be quarterly reports, but you want to set that pace from the beginning and then make sure that you stick to it, because that's going to be very important as you go throughout. So reports that are shared to the team. So most times these are going to be financial reports. Usually your property management company will have an accounting department, and they're going to put together a package that they'll send to you at the end of each month. And it'll have all of your basic financials. It'll have your rent roll, your income statement, your balance sheet. Some property management companies you'll find are a lot more thorough than others. Generally, the larger the management company and the larger the property, the more thorough and detailed the reporting that you'll get. Probably unrealistic if you have an 8-unit property to expect a 200-page report each month. But if you have a 300-unit property, that's probably what you're going to wind up with. So just kind of keep that in mind. Okay, so property management. So the property management is going to be the one in charge of executing the plan. Keep that in mind. So as the asset manager, you're going to be in regular communication with them. You want to make sure that you're helping them address any issues that they're unable to resolve themselves, or that they don't have the authority to resolve because of the management agreement. And you want to make sure that you're proactive, because the worst thing you can do in this space is be reactive. Once you become reactive, then you're fighting from behind and it becomes a lot tougher to win. Keep that in mind. So you want to be able to try and anticipate problems. And sometimes there are things that are going to come up that you can't control, but you want to do the best you can to get ahead of things that you can control. Project management. So project management can be a lot of different things. It could be construction management. So if you're going in there and you have a sizable CapEx budget and you're going to be upgrading units or making improvements to the exterior, there's a certain degree of project management and construction management that's needed. Now, what you'll find is many larger property management companies typically do have a construction management or project management division as well. But some of them aren't really equipped for that. So if you have a very sizable CapEx budget, you want to be preparing somebody on the team to be in that role. And that could be everything from scheduling contractors, purchasing materials. You can get very in the weeds if you want. Obviously, the more in the weeds you get, the less projects you can work on simultaneously. But sometimes you'll find that we'll deliver a better result. So it's going to depend on the strength of the team and the skill set of the individuals. Okay, so asset management. So asset management is really going to steer the ship. Keep that in mind. That's the asset manager's role. So when you see a problem, you have to figure out what the solution to that problem is and then communicate that to the team members so they can execute it. And different markets and different properties present different challenges. If you're going out there and you're buying an A-class property in a market that has a lot of new supply coming online, it might be different than solving a problem with a C-class property in a market that's underserved by affordable housing. So you have to look holistically at both the property and the market and understand where you can go out there and make improvements that are going to benefit the financial operation of the property. And financial reports we touched on a little bit. So your most common ones are going to be your balance sheet, your income statement, your rent roll. You'll see those in a lot of cases. Additional reports that you may also see, a delinquency or a payables report. That's going to be very important because it's going to let you know which tenants owe how much money. It'll say tenant A in unit 102, they owe $2,000. So one of two things is going to happen. Either that tenant's eventually going to catch up or they're going to be evicted. So you need to understand what the status is and make sure that you're being proactive with that process. Your receivables. So just like your payables are important so you know what's coming in, your receivables are important because they tell you what's going out. So if you're looking at a list of payables and you have a lot of bills that are over 60 or 90 days, you're probably going to have a lot of vendors that are pretty close to cutting you off from service if they haven't done so already. So that means you need to have some type of cash infusion coming into the property, either through operational cash flow or somebody on the team or the investor pool that's going to be ponying up additional money. So just make sure you're keeping an eye on the financials because those are really going to dictate the overall health of the property. So market reports. Market reports can come from a lot of different sources. You have a lot of paid sources like CoStar or Yardi Matrix that can be great resources. Most times they're going to provide you with details on the demographics in the area. So it's going to show you, what does the employment picture look like? What are the income demographics? What does the average person in this area look like? How old are they? Do they have a family? How many household formations do you have? So it lets you know, sometimes it can indicate whether or not you may want to hold or sell an asset. If you bought into an area that was on the upswing and now it's had some growth, but you see in the reports that it's starting to flatten out or maybe even decline, it may be time to sell that property unless you're really committed to holding it for the long term. So that's where the market data is going to come in handy. And investor reports, they're really going to encompass a little bit of everything. Now, one thing you'll see in this business is that investor reports come in all different sizes and shapes. Some good, some bad, some ugly. Now, there are some people that will give very minimal information. They may just give you a rent roll and an income statement. There's others who are going to give you a full financial package, and they'll give you probably some type of summary narrative that explains where the property is, how it's performing. So in most cases, from my experience, most investors do not sit there and read the reports. The reason that if it's a syndication and they're passive investors, the reason that they're passive is because they don't want to read 200-page reports. So as long as they're getting paid, most times they'll glance at the report but not dive too far into it. It's usually on deals that aren't performing and that aren't meeting expectations that you'll see them spend more time diving into and asking questions on. So just keep that in mind. Okay, so your investors. So, communication again is key. So you'll notice a common theme throughout many of these slides, and that's communication. And to be successful in this business, regardless of which side it's on, whether it's asset management, property management, syndicating, whatever it may be, communication is going to be the real piece that holds everything together. And you have to be effective at communicating to your team members, to your investors, to your vendors, and making sure that everybody understands what the big picture goal is and what you're trying to achieve with an individual project. Again, set those expectations up front. So with most of our deals, we usually aim to do monthly reporting. So we usually spell that out when we present the offering, so that way investors know what to expect. And you have to let them know how are they going to receive it. So are they going to receive it by email? Are you going to use an investor portal? Are you going to use snail mail, which most people don't do nowadays, but you could if you wanted to. A summary. So the summary is going to be really a 1 to 2 page narrative. Most times that'll suffice for most of the investors, and that'll encompass most of the major points of the operation. So you might have a brief paragraph on operations, another paragraph on financials, another paragraph on any legal items pertaining to the property. So big picture items that'll really sum it up so they can look at a glance and understand what's happening with the investment. The most important part, financial status and distributions. If you pay out distributions as promised, most times your investors will usually be happy. When you don't pay out distributions, let me be clear, they'll be very unhappy. So ideally, if it's something that you can control and it's something that you've projected up front, you want to do the best you can to pay out distributions on a regular basis, whatever that frequency may be. Project status. So the project status, in a syndication, most times you're dealing with a shorter timeline, 3 to 5 years. If you're doing a JV, it could be a little bit different. And what you'll see in a lot of cases with JV scenarios, you probably won't have the same level of reporting that you will with syndications. The reason for that is because all the parties have an active role, so they're generally more in tune with what's going on. And with syndication, what you'll find is it's just as much about the sizzle as it is the steak. So in the project status, you want to be updating people on where you are with the execution of CapEx, if that was part of your plan. If you were repositioning the property and you're changing a tenant base out, update them and say, we've had this many tenants leave, we've had this many tenants move in, this is how many units we've upgraded, and it lets people know where they are. And same thing as you're getting ready to sell, which we'll talk about later in the presentation. So you want to keep them posted and say, well, our plan is to position the property for sale in the next 6 to 12 months. We're going to be doing this, this, and this to get it ready. And then we'll be putting it out there to several different brokers and run a marketing process. And a refi or sale status. So that kind of ties in. So keep in mind, certain business plans include a refi, certain ones don't. Most times you can have both a refi or a sale as your options, because those are the exit strategies you're going to have in this business. And either one of those would be considered a liquidity event that could return some or all of the capital to the equity partners. And again, market status. So you want to update the investors what you find out about the market. Now, keep in mind, sometimes you don't need to communicate everything to the investors. You want to give them any material points that they should be aware of, but sometimes too much information isn't necessarily a good thing either. So it's striking that balance over what you should and what you need to give versus, what's good for you to know as an operator, what somebody who may be a passive investor in a deal doesn't truly need to know. And also what's new. So you want to make them abreast of what's happening at the investment, what's happening with the market, both positive and negative, and you want to share information that's going to make them happy they invested with you. So distributions, we talked about that, and distributions are definitely key. That's really why people are getting in there, right? So the financial reporting, and most times what you'll see is with the distributions, you'll give the investor some type of statement as well. So the statement will usually indicate what they're getting paid and when they should expect it. For anybody here who's ever invested in a stock, you're probably used to seeing reporting where, through their disclosures and their announcements, a lot of times they're going to indicate if you were an owner of X number of shares on this date, you'll receive this distribution on this date. So similar to that, you want to use a similar trait as you do reporting here for investors so they know what to expect and when to expect it. The capital account balance. So this is going to let them know how much equity they have in the deal. So if somebody's invested $50,000 in a syndication deal, then that would be their capital account balance. And that balance could be reduced or increased depending on what goes on throughout operations. Many times if you have a refinance, usually you're returning all or a large portion of the capital. So that's going to reduce that investor's capital account balance in the deal. And it'll leave them with lower equity in there. Return of principal. So this is more pertinent as you get closer to a liquidity event. Once you do that, you want to keep the investors abreast of what to expect and when to expect it. CPA roles and responsibilities. So keep in mind, even if you're running a syndication or a JV, the accountant that you use for the property is probably going to be different than the one that you use personally, at least in many cases. And if you're doing a syndication where you have a lot of investors, you can almost guarantee there's going to be many, many accountants that are handling various different returns. So the responsibility you have as the asset manager is the tax return for the entity that owns the property. And if there's any other entities affiliated with that, then you want to take that responsibility as well.
Hey,
Now,
Charles.
you want to make, yes.
So Sri has a question in here. He wants to know, for reporting from you, whether it's weekly, monthly, or quarterly, either project status, refile, sales status, or any other status, what CRM are you using? Additionally, do you provide portal for the investors, log in and review their investment status? If yes, what are you using as a CRM and as an investor portal?
A good question. So I'll start with the investor portal. Right now, we're using Cashflow Portal. There's a lot of different portal options that are out there. We've been using that one for about a year, and so far it's been pretty good. But there's several different ones out there, and I'd recommend that when you get to the point of subscribing to one, you probably want to demo as many as you can and see which one works best for you. What I would also recommend, if somebody's brand new, I don't think it's a wise move to go out and subscribe to an investor portal right at the beginning. Most of these portals do have a cost associated with them. So I would tell you it's much more important to focus on building momentum before you go out there and start spending a lot of money. Keep that in mind. For the CRM, right now we use Kartra and Go High Level, which actually David was very helpful with us setting up. And that's where we track all of our communication with investors and prospective investors. Okay, so then the business plan. So what do we have in the business plan? Well, the first thing I'm going to talk here is the property. So your renovation plan. So how much money do you have budgeted for CapEx? Most times you're going to go in there with a high level budget. So I'll give an example. There's 2 properties that we bought last year. So we had our third-party property management company do the due diligence inspection. With that inspection, at each of those properties, they did a 3-day inspection. They probably had something between 30 and 40 vendors there, each property. And they had something like 3 plumbers, 3 roofers, 3 foundation guys. So they're getting usually multiple bids on all of the major systems and components of the property. So what we then do is we take that information and we compile it into a budget. and we figure out and say, okay, based on the scopes of work and the pricing that we have, what do we think is a realistic number? And that's how we kind of build out our CapEx budget. So then as you acquire the property, you're using that as your guideline to be able to move forward. And you're going to say, okay, so one of the properties we budgeted $192,000 for roofing, and we budgeted $65,000 for a fence and gate installation. So now as we're going out there executing those projects, we want to stick as close to the budget as possible. But guess what? We did our due diligence inspection on that property in May. We're executing the work 6 to 12 months later. So sometimes pricing changes. Keep that in mind. It may not be exact. You want to do the best you can to stay as close to the budget as you can, but also have an understanding that it's not realistic to expect pricing to hold for that long period of time. Scheduling. So right up there with pricing is scheduling and timing. So once you give a vendor the green light, how fast can they start the work? If they're backlogged for 6 weeks and you're looking to start next week, that's probably not the right fit. You may need to go out there and find some additional vendor bids or see if there's a more cost-effective way for you to do it in the timeline you want. If timing is less relevant, then maybe that's not so important, but either way, you want to be clear and you want to have projected start and end dates for the project so you're able to go out there and execute. Your budget. So, the budget obviously very important. Most times you're going to have a very high level budget on the front end, but then as you get in there and you start really diving into it, you can get into the nuts and bolts and the minutia with it. And accountability. So one thing you'll see with contractors is a lot of times excuses come up. And you need somebody who's going to be watching and communicating with them on a regular basis. And that could be a construction or a project manager on the site. It could be a team member who's regularly communicating with them by phone, text, email, whoever it may be. And what I would tell you is if you're not at the site, you probably want to insist on getting pictures and videos also, because believe it or not, people lie. So sometimes people are going to tell you work is done or so far done, and it's not. So if you can't see it with your own eyes and you don't have somebody on the ground who's doing that for you, make sure you're getting something to verify that they're actually doing what they're telling you they're doing. Property visits, and that ties right into it. So in this business, you do need to visit the property occasionally. Can you do things remotely? Sure, but you'll need to have somebody in the market that you can rely on and get information from. And it's not a bad thing for you to show up at the property sometimes too, so keep that in mind. Sometimes it keeps people more accountable and they know there's a chance of ownership popping in, and it just makes people that much more motivated to work.
Hey,
Okay, so
Charles.
now we have property management.
Charles,
Yes.
before you move on, Mel has asked a question regarding distributions and return of capital. If you don't mind, I'd like to answer it, and then you can add on anything you
Sure.
want. So Mel's question was regarding distributions. When one promotes a return of capital, so let's say there's going to be a refi event, and they say, we're going to give you so much capital back at the end of this refi event, is that represented as a dividend or distribution, or should these cash flows better reflect a return on capital? So I'll start there. That is a return of capital when money that you invested is returned back from a capital event. Any money that you receive from distributions or dividends is considered return on, not return of. If they ask you for 50,000 in an investment, but they only use 35,000 of it, if they return back 15,000 and count that as a return on, that is considered fraud. You cannot do that. That is a return of capital, not a return on capital. So let me continue with this question. Not sure if this is a nuanced accounting question, but when he took CCIM CI 101, they're taught there is no return on capital until there is a return of capital. Now that Mel, is at the sale of the property. That is true. During operations, you are receiving a return on capital through distributions. It's almost like having an interest-only loan, only you have equity, it's not debt. So you will have return on during operations, but at the capital event, whether it's a refi or whether it is a sale, you have to have a return of before you get the return on. Did that answer your question, bud? Charles, you want to add anything to that?
No, I think you nailed that spot on. The only thing I would say is that, you want to make sure that you're following the operating agreement. So different operating agreements are written differently. Some of them will state, that a return on capital could be given at a certain point and a return of capital will be given at other points. So just make sure that you understand how your operating agreement is written. One thing I would tell you, just, something from the industry, and this is probably more specific to syndication than JV type setups, because syndications involve securities law, which goes a little more into it. But the thing is, there's a lot of operators who mistakenly give out distributions when they shouldn't, and that's bad. That's very bad. So you have to understand what your operating agreement says, and you have to adhere to it. So in the event that you wanted to do a return of capital, maybe in the first year or two of a heavy value add deal, so people feel like they're getting something, if you state that in the operating agreement and you present it that way, that's okay. But if you're giving a return on capital when it's not actually due, that's a major issue. So you have to understand how the operating agreement's written and just do the best you can to adhere to it at all times.
Just remember that return on is profit. Return of is equity.
Right. Okay, so then
Thank you, guys.
you're welcome. Okay, so then the business plan on the property management side. So the operating partner, so they're going to be the one who is on the ground executing. So it's important that they know what the plan is. So earlier in the presentation, you heard me mention that we usually do a kickoff call or meeting with all of our management companies after acquiring a property. So one of the things we do is we share with them our projected budget, and we share with them what our plan and our vision for the property is. So that way they're on board. Because again, if you don't communicate these things, yes, you can get mad at the property manager for not executing, but if they're not aware, it makes it very tough for them to execute. So you have to make sure that they understand what's expected, being that they're going to be the one tasked with executing it. Your annual budget. So we normally present our property management companies, most of our projections are on a 5-year period. So we'll usually give that to the management companies at the beginning and say, look, here's our projection for each year. Now, sometimes as things happen, projections change. So keep that in mind. Projecting 5 years ahead isn't always an exact science. And sometimes things change. If you bought a property in early 2020 and you projected 5 years ahead, there's a good chance you did not predict the inflation that we saw in 2021, 2, or 3. So because of that, your numbers would have been off. And what's going to happen is usually your management company is going to produce an annual budget at the beginning of each year, and they're going to discuss it with you and send it to you for approval. So you need to use the information in front of you to determine whether or not that fits the plan. Communication. So again, being in touch with them on a regular basis and making sure that you're helping them get through any obstacles they're facing, that's going to be very important. And reporting. So the reporting is really the pudding. When it said that the proof is in the pudding, well, the reporting is the pudding. That's going to tell you whether or not your property is doing good or bad, whether or not you're executing the plan, and it'll also let you see if you need to go out there and make changes. So for property visits, this is going to be both, on the management side and the ownership side. So on the management side, depending on the size of your property, if it's a larger property, typically north of 100 units, you're probably going to have full-time staff, and there'll probably be a maintenance person and a manager that'll work at that property exclusively. But you still want to see that the management company is sending a higher up person there to periodically check and make sure things are moving in the right direction. That person most times is a regional manager who has some type of jurisdiction over a larger area, and they're going to be tasked with making sure that the on-site staff is executing. If it's a smaller property that doesn't have full-time staff, then the property manager may wind up being there more frequently to lease units and to do basic things because they don't have somebody on site to rely on for that. And on the ownership side, your property visits come in handy because they keep everybody honest. Okay, so now we'll talk about project management. So, what do you need here on the team? So the first thing is your project manager, and that's going to be the person responsible for steering that part of the ship. And usually that's going to be your CapEx and your construction, and they're going to have the expertise and the organization skills to go out there and do that. Your maintenance personnel. So maintenance personnel at their core are going to be used for your work orders and ultimately repairing basic things on the property. Sometimes if they're more skilled, you may even be able to have them do larger things, maybe replace HVAC units, maybe do some plumbing work, maybe depending on the workload you have, even some unit turns. So it all depends on the skill level and the quantity of the personnel that you have there. So what's important when you go through the maintenance personnel? Payroll. So that ties back into budget. You want to understand what something's going to cost you. Now, keep in mind, guys, real estate is very hyper local. So if you go out and you hire a maintenance man in Louisiana, it's going to be a much different cost than if you go out and hire a maintenance man in New York. So you want to understand what a reasonable expectation is in those local markets that you're looking at, and make sure that you're budgeting for that and that you're doing your best to hire for that. Subcontractors. So the subcontractors are going to be outside vendors. If you have a property that's large enough to support on-site staff, the goal is to have the on-site staff do as much as possible. The more that you need to outsource, the more money it's going to cost you. So just keep that in mind. One of my friends from the property management industry described it pretty well when he went his approach to hiring a maintenance person. And what he always said was, if I need to call a plumber for this or an HVAC guy for that, then what do I need you for? So I've always found that to be a very reasonable expectation. So keep that in mind. If you're going to hire somebody, you want them to do as much as you can. So that way you don't need to use outside vendors for everything. So your exterior renovations, who do you need here? Well, again, first thing you need is your budget. What type of budget do you have? What projects are you doing? And what vendors do you need for them? And what's your timeline to actually execute? Interior renovations. So how many units are you doing per month? What are those units going to cost you? And what is your timeline? So most times on a property, what I would tell you is if things go perfect, and when I say perfect, like everything really perfect, you can probably do 8 to 10 units a month if it's a larger property. But in the real world, most times things do not go perfect. So I wouldn't tell you to project perfection. Now you may aim for that, and you may aim for that best case scenario, but it's probably not what you want to be projecting for. So 6 to 7 units a month with a more sizable property is probably a realistic number. But again, it takes proper planning and proper execution. So if you're waiting until those units become vacant to go out there and line up vendors and order materials, then it's probably not going to move that fast. But if you're surveying the units 2 weeks before they become vacant, and you already have the labor lined up, and you have your materials stored somewhere safely on site, and they can start on day one, then you can probably execute that. So it's all really planning and execution, and that's going to be a big piece of it.
Charles,
Yes.
For your planning on interior renovations, tell them how you utilize your lease analysis during due diligence to make that initial plan.
Yeah, absolutely. So with the lease analysis, what you're going to do is, if you're doing a lease audit, you're really comparing to see what the property is billing out versus what they're allowed to bill out. And then what you're further doing is taking your projection and saying, okay, if the rent is $900 now, but I believe I can get $1,200, this is what I want to do to this unit. So I would always tell you to reverse engineer something. You can go out there and take a C-class property and put a 5-star unit in there and spend $20,000 a unit. But if you're only getting a $50 rent bump, was it worth it? And the answer to me is no. Some people might have different opinions, but that's not the return I want. In general, I aim to get a 20 to 25% return on whatever the CapEx cost is. So if I'm spending $10,000 on a unit, then if I'm getting about a $200 a month bump, that's $2,400 in the first year. That's like 24% of your cost. Okay, so that makes sense. But if I'm going to spend $10,000 and I'm only going to get a $50 bump, that probably doesn't make sense. So keep in mind, you want to use the starting point and your projection for where you believe you can be on how much you're spending and what you're doing to those units. So if you can only get $50, then you know what? We're not putting in new countertops. We're not replacing cabinets. We're not, you're not doing any of those things that are going to start getting costly. We'll put new light fixtures in. You get new light fixtures and you fix what's needed. So use that as a guidepost as you build your plan out. So subcontractors, hiring and firing, and this is also going to apply to employees. You have to fire fast. If somebody's not working out, you can't keep using them, otherwise it's going to be detrimental to your business plan. And it can hurt you both financially, and also it can take much longer than you expect it to. So I'm not saying go out there and fire a vendor mid-unit, but if they're turning 10 units for you and the first one isn't great, you probably want to pull the plug before they do the other 9. So just keep that in mind. So bonuses and penalties. So oftentimes, if you incentivize people to perform, they do. Think of it like a baseball player again. A lot of contracts have milestones built in. If you hit 40 home runs, you get this bonus. If you hit 50 home runs, you get this bonus. And you'll notice those are the years where those guys go out and hit 40 and 50 home runs. So kind of the same thing here with contractors. If you say, okay, we're expecting you to finish by this date, but if you finish 3 days ahead of schedule, we'll give you an extra $500 or $1,000. Conversely, you can say, okay, we're expecting you to finish this date, but it takes you an extra week or an extra 2 weeks, then we're going to penalize you and reduce this much because now it's costing us rent. Experience. So experience is always important. And keep in mind, you got to pay for experience. So if you want good quality work from good quality people, they're going to charge you more than somebody who's going to run a Mickey Mouse operation. And you need to decide what you want from the beginning and just make sure it fits with the budget and the plan that you have for the property. Lien releases and waivers. These are very important. So one thing you'll see very common in the construction industry are mechanics liens. And that's something that a construction company files when they don't get paid for a project. So you as an owner must give them a lien release. And what that release basically says is that they're going to hold you harmless for any payment up to that point. And usually it's going to specify a dollar amount or a specific project, and you want to keep that on file. 1, for yourself, and 2, if you have a CapEx draw from the lender, they're usually going to ask you to see those before they release payment, because the lender does not want to release payment on something that could eventually wind up with a lien on it. Okay, so your subcontractors, paperwork. So what paperwork do you need? Well, a W-9 form. And that's going to be for most vendors. So your W-9 is very simple. It's just going to be the name, address, and tax ID number of the party that's getting paid. So you want that for tax purposes, because at the end of the year, depending on how much work they did, you may need to send them a 1099 form.
And just to add to that, Charles, anything above $600, W-9 is required by the IRS.
Right.
And if you don't get it, you're responsible for paying the tax.
Yes, and you don't want to deal with the IRS, so well, not more than you need to, so keep that in mind. And we have a question in the chat box. How do you manage a property with high vacancy rate that also requires renovations? Do you begin by increasing occupancy through rent concessions while simultaneously renovating vacated units, or do you renovate all unoccupied units first and then attempt to rent them out upon completion? Great question. And the answer is there's no black and white answer. You'll see different operators have different preferences. I'll give my answer and then I'll tag David in for his feedback too. But for me personally, I prefer to have some cash flow at the property. So my thought would be, I'm going to start with the unoccupied units, and I'm just going to work on turning other units as they become vacant in the natural course of business. But you'll have some people that would prefer to just vacate as many units as they could and do them at once. And that's preference. There's benefits to both sides. It just depends what you want. David, what are your thoughts on it?
So for me, it depends on where you are in a market cycle, depends on who your lender is, if you have investors or not, and what your business plan says. Uh, in an expansion market, there is room, especially if you have a little cash flow to pay the debt because you got an interest only loan or an interest only period, that you may be able to do the renovations and still be able to service the debt. Um, in that case, it's just preference, whatever you want to do. In the market we're in today, as we enter the plateau phase, which is the oversupply phase, and start to enter what is called the crisis phase, which is the recession phase of a market cycle, you need to have cash flowing properties. So if you were to purchase today, like there was a deal, a 200 unit deal, I think it was in Georgia, in South Atlanta, from some, guru named Tim in Ohio. I can't ever remember his last name. And um, he's selling this asset at some just crazy number. So if you were to purchase that asset, and it is sitting at 50% vacancy right now, my number one priority is beds and heads, or heads and beds. I want to lease units because I've got to get the NOI up high enough where I can service that debt, because your NOI more than likely is going to drop as rents continue to decline in the markets. Make no mistake, they are declining. Tim Bratz. Thank you, George. That was him. They are declining in markets. So the longer this goes, the more markets will start to decline. So you have to get that occupancy up in order to get the NOI high enough to be able to service your debt as the rents start to decline. So that to me would be priority, and renovations would take second seat to that. So again, market condition, property condition, lender compliant, what part of the cycle you're in, these all have factors.
Mhm. Okay, so licenses and certificates. So if you're dealing with somebody who's a licensed contractor, maybe it's a plumber, maybe it's an electrician, even a general contractor, you want to make sure they have the proper credentials to do whatever work it is they're doing at the property. Bonded and insured. What I find in my experience is that most smaller contractors typically aren't bonded. A lot of larger contractors are, so I don't focus as much on that. But if you can get it, it's a bonus. But insurance is something you don't want to compromise on. So most contractors should carry general liability, workers' comp, and auto insurance. Some will also carry an excess or an umbrella liability policy. So you want to make sure that you're getting an insurance certificate from them prior to starting the work. Why is it important to do prior to starting the work? Well, the odds of getting a certificate once an incident occurs are much slimmer. So keep that in mind. When they're starting the work, they're motivated because they want to come in and they want to do the job and they want to get paid. So you want to get that on the front end, just in case something goes wrong, you have that on file. So workers' comp, that's going to protect them just as much as it will you. If they have employees of the company, they have a responsibility to have workers' comp insurance, and that requirement is going to vary from state to state. But basically, if somebody gets hurt on the job, that employee can file a workers' comp claim, so you want to make sure they have that. So your lease-up phase. So you want to have a good relationship with the property manager, and you want to be confident in their ability to execute. So when you're leasing up, especially if it's a big lease up, you want somebody who's very personal and somebody who has an ability to win prospective tenants over. They need to be, responsive. They need to be communicative, and they need to be personable enough to bring people back. Pre-leasing. So one of the things you can do on the management side is pre-leasing, and that's being very proactive, which is good. So pre-leasing means that you're getting a lease signed for unit before it's ready. So let's say if you have unit 101 and the tenant's leaving on January 31st, and you know that. So you could wait until January 31st, do your inspection after, and then get your vendor in there to do that. But by that point, you've already lost time. So if you're going in there a week or two before the tenant leaves, inspecting the unit, seeing what's needed, and ordering your materials and scheduling your vendor, then they can jump on it probably within a day or two of that unit becoming vacant. And by pre-leasing it, you can say, okay, we have a lease signed for February 21st. So you tell the vendor, look, here's your timeline. It has to be done by this date. Otherwise, we have to, push this tenant back, and that's going to cost us money.
Charles, can I segue on that for a second?
Yes, absolutely.
So it's not something that's used a lot in the residential world, multifamily or single family. But one thing a lease does for you, especially a pre-lease, is it gives you an asset. And so now, if you're short on a renovation budget and you need to borrow money from a lender or a private investor or somebody like that, now you have proof that this unit is already going to be occupied. You have a lease signed, there's guaranteed payment. So it gives you an asset that you can take, and this that you could take to a lender and be able to get some money for it. This is more prevalent in the commercial world. And I wanted to bring it up because there's a couple of people on here that are in the commercial space as well as multifamily. So if you can get a pre-lease signed, that gives you the ability to have an asset to be able to use as collateral for lending.
Mm-hmm. Concessions. So that's a word that's become a lot more popular in the last 6 to 12 months. For some of you who are newer, it may not have been in your vocabulary so much in the prior years. So concessions are any type of discount or special. It could be if you're offering half off the first month's rent to try and get somebody in. It could be if you have an employee that's living on site and you're giving them a free or a discounted rent. Uh, one special we ran last year at a property, a C-class property in a C area, is we offered free Amazon Fire TVs to anybody who moved in. So you may have to use different concessions depending on where the market is and how well the property is performing to attract prospective tenants to move in. So keep that in mind. And a really big piece of that is going to be what the competition is doing. So if you are in an area and you have 5 properties and 3 of those are giving concessions, there's a good chance you're probably going to need to give some concessions too, unless your rents are just so far below the competition that people are motivated to move in anyway. And especially with a larger lease up, keep in mind the larger the lease up, the more concessions you're going to give. A lot of times with new construction, even in the best of times, they're giving a lot of concessions on the front end. And the reason they're doing that is because it's more important for them to stabilize the asset and potentially be able to sell or refinance it. So you'll see a lot of Class A properties in the best of market conditions that have tremendous concessions. But those concessions get less as the property gets stronger occupancy. So when they're signing their first lease, they may give some very large concessions, but when the property's 83% occupied and they only have a handful of units left, those concessions start getting less and less because there's not a need to keep doing them. So keep that in mind. And feedback. So you want feedback from both your property management staff and also from any prospective applicants that come in. So what are people saying about the property? Are they saying that it's somewhere they want to live? Are they saying that maybe something isn't attractive about it? Maybe they don't like the staff. Take some time and read the reviews online. That goes a long way sometimes. Admittedly, it's probably something I don't do as much of that I should. But if you go on Google and you go on apartments.com, they can give you some very good insight into the property and the performance and things that you may be able to improve upon. Then we have exiting the deal. So if you're in a syndication structure, you're definitely going to have an exit. If you're a JV, you probably want to have that as an option, even if you do decide to keep it as a cash flowing asset in perpetuity. Okay, so the first thing is market timing. So do you have a timeline to exit the deal in your PPM or operating agreement? So if you're doing a syndication, there typically is a hold period. For our deals, we typically do 3 to 7 years. And I put a range there purposely because I don't want to be locked into a specific time. There's a range because market conditions change and things fluctuate, and sometimes you need a little bit of wiggle room. But if you have a certain hold period in those documents, people are expecting you to make good on that hold period. So see what they have in your documents, because that'll go a long way. Market dynamics. So most operators who bought in 2019 and 2020 should not have been predicting the crazy appreciation that we had. There probably were some that were, they shouldn't have been. But even if they didn't predict it, many of them would have been foolish not to capitalize on it. So what that means is, let's say if you have a 3-year hold in your documents, but you bought the deal in 2020 and now prices have went absolutely nuts and you can make a killing in late 2021, then you make a decision that's in the best interest of yourself and the investors, and you sell that property. So there's a lot of people that made crazy money in a short period of time. And that's where the dynamics come in handy. Conversely, let's say if you bought a property in 2022. So for anybody who's following the market, you probably realize that there were substantial changes in price from 2020 to 2022 in most markets. So if you bought that property in 2022, maybe that's not the case, because maybe the market you're in saw prices come down. Matter of fact, I'd venture to say that most markets have seen prices come down since 2022. So what that means is you might have a longer hold period, because you might not have a buyer out there who's going to pay the price you need to exit the deal. So market dynamics play a big piece in it. The rent roll. So how strong is the property's performance? Where is the occupancy? How much rent are you bringing in every month? What's the potential to bring in more? Because those are all selling points potentially to buyers. So 90 days above 90%. Why is that important? Well, that's important because most buyers want to use conventional financing. And that could be, an agency loan, Fannie Mae, Freddie Mac. It could be other types as well. But for most types of conventional financing, you're going to need to have the physical occupancy above 90% for at least 90 days prior to the closing. That's a big thing. So your operating expenses versus capital expenses, what does that mean? It means that as you're getting ready to sell your property or even refinance, you want to go through your financials and make sure things are accounted for properly. So if you have $100,000 in your operating expenses, that should really be below the line. Is that going to make a difference on your pricing? Absolutely. So you need to go back and have the property manager make adjustments. One of the things that we do in our properties, we go through the financials pretty regularly, and we see what we can put below the line, because we want to make sure we're doing that so our financials look good when we're presenting to people. Okay, so you got your outside team. So you got the broker. When you're exiting a property and you're selling it specifically, your broker's going to be very important. So what can the broker do? Well, they're going to take your property, they're going to package it up, and they're going to put it out there to a whole pool of prospective buyers. Most of us in here probably know buyers within our own networks, but I'd venture to say that none of us has a network as wide as a broker, because that's what they do for a living. They go out there and they build relationships with buyers, and they're able to put your property in front of a wider audience. So there's a lot of national brands out there. If you're dealing with larger properties, you'll notice that there's a very select group of brokers out there that really play in that space, and you want to be engaging one of them to get max exposure. If it's a smaller property, a 10 or a 20 unit property, you may want to consider different approaches, because sometimes the bigger groups won't really touch those, but it may be a combination of either a residential broker or more of a boutique broker that specializes in smaller multifamily. A call for offers. So when you run a marketing process, the call for offers is typically the end of the initial round. The way most marketing processes work is they have usually 2 rounds. And if it's a really hot seller's market like 2021, maybe 3 even. But you'll see in most cases, they have 2 rounds, and the initial round has a call for offers date. And typically at the beginning, or sometimes throughout the process, the broker and seller will agree to a date when the offers need to be submitted by. And the broker is going to communicate that to any prospective buyer. So that means if you're planning to submit an offer on it, it has to be in by that date. Now, I'll give you a little secret. Most buyers do not submit their offers in advance of that date because they like playing things close to the vest. The only time I'd really recommend submitting it early is if you're trying to preempt that marketing process. But to do that, usually you're going to need a pretty compelling offer. So your lender, what's the lender going to do? Well, on the sell side, you're going to need to understand a few things. One, does my loan have a prepayment penalty? That's a big thing that a lot of people don't account for properly. And it can definitely influence your decision to buy or sell. Even at times when the market was quite a bit hotter, like in 2021, and I was looking at deals, there was one deal I made it to a best and final round on, and I guess the seller hadn't quite done their homework and they didn't realize how much their prepayment penalty was. So all of a sudden it shifted their opinion. I said, well, we're only going to sell if we get an assumption because it didn't make sense for them to sell with new financing at that point. So you have to understand that. Does your loan have an option to assume? So if you took out financing in 2017, there's a good chance your loan assumption may not be that attractive at this point. But if you have a loan from 2020 or 2021, where have interest rates went in the last 3 years? Who's been keeping a close eye on that? David's pointing up. I agree. So a lot of times if you have a loan from 2020 or 2021, that can be a selling point because those loans have interest rates in probably the 3% range most times. So, understanding if your loan has an assumption option and what that process looks like so you can go out there and present it to a buyer. So some loan agreements require you to give the lender advance notice of the sale, and the loan agreement will dictate usually how much notice you may need to give them. So 60 days is a good barometer, so you want to give them a heads up on there. Definitely penalties, that's a big thing. And payoff and assumption. So as you get closer to a closing date, you're going to need a payoff letter because what will happen is you have to give that to the title company so they can go out there and make sure the lender gets paid on the day of closing. Keep in mind, if the lender doesn't get paid, they are not going to release their lien and you will not be able to sell the property. So that's a big thing. Okay, so then you have your escrow and title. So why are they important? Well, they're going to hold the earnest money deposit. So that's going to be held in their possession, and in most cases, it probably won't be released until the closing. Closing attorney. So the closing attorney is going to be dealing with the escrow or title company, and depending on the state you're in, you could have one or the other take the lead. Your CPA. You want to be prepping them because that's going to be very important after the sale. You want to have them advise you on what type of tax liability might be due. So especially if you're in a syndication, but even a JV type structure, you want to be aware of that. For us with the syndication side, yeah, there's different ways to do it, but the way that we typically do it is we're going to ask our CPA, how much do we need to hold back for state income tax? And you could pay it out to the investors and have them take care of it at the individual level. On a personal level, I've never been a fan of that because sometimes people don't do that. So that could still potentially come back as a liability to the entity that owns the property. So we usually like to take care of that on our end. So just understand what your liability is and have a plan for that liability, either paying it, maybe a 1031 exchange, but some type of plan to take care of that liability. So the CPA, you also want to give notice and you want to have them prepare any distributions. So that way you can have those out to the investors once the closing occurs. And you want to make sure that they're withholding, as we said, the proper amount of tax and also issuing any K-1s with that final tax return. So then the call for offers, what do you have to do as the seller? Well, okay, the first thing is negotiate a hurdle with the broker. So similar to the way a syndicator would have a hurdle, you can give the broker an incentive as well. There was an agreement that I had signed last year where we gave them a flat fee of 3% for a certain dollar amount up to X, but if they got X plus 1, then they would get a bonus kicker for that extra percentage. And sometimes you can negotiate agreements with a flat fee as well. It also depends on what you want. So listen to the broker's directions. I think that's very important. When you're hiring an expert, it would benefit you to actually take their advice. Unless you're a broker in the commercial or multifamily space, you probably do not have as much expertise as they do in that matter. So you want to listen to their direction and ask them what they see the best results with and make sure that they're executing it. So preparing all the acquisition documents, most times what's going to happen is in today's world, the broker is typically going to give you a OneDrive or a Dropbox folder until you start uploading all of your due diligence documents. So that way, once the contract is signed, they can give those to the buyer right away. Make your property management aware of the sale. So if you're running a full marketing process, there's a very good chance that your management is probably aware anyway. They'll probably be meeting prospective buyers and the broker at the property to give them tours, probably giving them information. If you're not running a full process and you're just trying to shop it off market, you may not want to make them aware if you're not 100% sold on selling yet, because you want to make sure that they don't leave. But if you know that you're going to be selling the property and you're doing a full marketing process, make them aware, because a lot of times you're going to get a better buy-in than if they don't know and they're surprised by it. And you want to coordinate with the broker and the management company for tours. So in most of the sale processes that I've been through, I'll usually do an introduction with the broker's team and also our on-site staff. And, they'll usually do a kickoff where they can just go meet and walk the property together. And usually the broker will start formulating a plan and say, okay, this is the tour route that I want to take prospective buyers on through the property. And they'll use the manager's guidance to say, okay, is there anything that we want to avoid? So if you've ever been on a tour and you haven't seen the ugly parts of the property, that's probably by design. Just keep that in mind. Okay, so then you have a best and final round. So the best and final round is usually your second round. And what that is you're taking all the offers that came in during the initial round, you're reviewing them, and you're usually narrowing it down to maybe a handful of offers of groups that you want to seriously compete. So get recommendations from the broker. Why are you doing that? Well, this is the broker's network. So they probably know those buyers better than you do. They know who they've transacted with. They know who's new. They know, different things about them. So as a seller, if the broker tells me, okay, we have 13 offers and 3 of them are from groups that he's transacted with before, 2 of them are from groups that he hasn't transacted with, but he knows they've done deals, and then the other 8 are brand new. Which 8 aren't making it to the best and final round? I'll leave that one with a little bit of mystery for you guys, but I think you can figure it out. So you want to narrow that pool down, and the purpose of the best and final round is having them sweeten their offers. So what can they do? Can they increase the price at all? Can they shorten their due diligence period? Can they put up more earnest money? Can they make their earnest money non-refundable? So what you're trying to do is have them compete against each other, almost like an eBay style auction, where you want them to drive the price up a little bit. Show me that you want it. Who wants this deal the most? Make it attractive to me. Qualifying the finalists. So this is something that's always important, but this is a million times more important in 2023 and 2024 than it was in 2021. To say that there were literally buyers coming out of the woodwork that you'd never heard of closing deals in 2021 is probably an understatement. But in 2023 and 2024, at least 2023, because that's done, you've probably heard that there weren't nearly as many deals getting done. And that's even from qualified buyers. And that's for all different reasons. It's for lenders retrading. It's for insurance premiums being crazy. It's for a lot of different challenges. So you want to vet the buyers as best you can to give yourself the highest probability of closing, because right now it's a tough market and even very experienced groups aren't closing for different reasons. Choose the buyer and at least one backup. So this is a great strategy. It's actually something we're using now for a deal we're selling. We engage the broker. We're technically on buyer number 3, but he didn't really tell the buyers that they didn't get it. They were just slow playing it. And that's why you hire a broker to do that. They're going to work the groups. They're going to screen them. The first group backed out because one of the partners on the team died unexpectedly. The second group backed out because they came down and told it they wanted to retrade and they had a crazy amount, so we said no. So you want to have those options there, because keep in mind, as a seller, you're trying to get the best deal you can for yourself. Now, as a buyer, they're trying to do the same thing, but from here, we're looking at it from the seller perspective, so just keep that in mind. Then you have your purchase agreement, which is your contract. So attorney draft, yours or theirs. from experience, what I would tell you, and I try to do this even as the buyer, but as a seller especially, you always want to have your attorney draft the contract. So the way I look at it is, some people look at it and say they're saving money by having the other party's attorney draft the contract, and maybe that's true. But what I would tell you is, each attorney's contract is kind of like having home field advantage. And every attorney knows their contract better than somebody else's. Because in the commercial space, it's a little bit different. For anybody here who's done a residential deal, most times you're probably using a standard state contract. And truthfully, you could do that in commercial, but for whatever reason, maybe it's just ego, it's not usually done. So every attorney is drafting a custom contract, and every attorney is going to know their own template better than somebody else's. So keep that in mind. So even if you spend a few extra bucks on the front end with your attorney doing the draft, it's probably worth it.
So if
Don't
I
let
can
the attorneys
segue
take
on,
control. Yep,
can segue on that for a second, Charles.
absolutely.
So with attorneys, they're like real estate brokers. When you hire an attorney, and if you're the seller, that attorney has a fiduciary responsibility to you. So that means they are going to make that contract benefit you more than the buyer, unless you give them guidance on more of a win-win solution. Now, they'll take the LOI, they'll use that as a draft in order to draft their document.
Yep,
So keep that in mind, that they work for you, not the buyer, which is why that next little point came up.
right.
But one thing you can do that is legal, if you wanted to, is if you're purchasing the property in your personal name, not as an entity, okay, in your personal name, then you can write the contract yourself, because we're able to represent ourselves in court. That's part of our Constitution. Companies are not able to represent themselves in court because they are not individuals. So if your company is taking title to the property, then you cannot build your own purchase agreement. But if you're purchasing it yourself, I just want to throw it out there with your name. You can write your own purchase agreement. You can write your own leases. I don't ever recommend doing it,
Yeah, I wouldn't
but
either.
you do have legal rights to do that. As an entity, you do not.
Yep. And an important point here, don't let the attorneys take control. So uh, oftentimes what can happen is attorneys like to flex their attorney muscles. And if we have any attorneys on the meeting, you're probably aware of that from your own experience, I'm sure. We, you know, there's different perspectives in this. The attorney that I use, I always joke around, he's like a pit bull. One of the brokers I know, they call him the Grim Reaper, because they say that they know when they see deals come through him, they usually get killed. I've never had him do that, but I know how to work with him. So to the point of the presentation, you need to be the one steering the ship, because it's still your deal and your investment. You don't want to turn away proper legal guidance, but you need to decide which points are worth fighting on and which points you can give on. So that's going to be important. Use the attorney to give you that guidance so you can make informed decisions, but understand that you're the one that's still responsible for the transaction being consummated or not. Earnest money. So as part of the offer and the agreement, the buyer is going to put up earnest money, and that earnest money, sometimes it can be refundable, sometimes it can be non-refundable. Right now with the conditions we're in, I would tell most people here, you probably want it to be refundable, because as a buyer, it's more risk. As a seller, you want it to be non-refundable, because a buyer with non-refundable money is a heck of a lot more committed. They find ways to get things done, because all of a sudden they don't want to lose that earnest money. So keep that in mind. Timing. So what timing are you going to have? So you're going to have timing for due diligence. You're going to have timing for the buyer to close. You might have extensions built into it. So you want to have all those things spelled out in the purchase agreement. Okay, then due diligence.
Let me segue on timing, Charles, if you don't mind.
Yep, absolutely.
One of the most important things with timing in a purchase agreement, this is a legal document. There is a clause in the contract that says time is of the essence. That statement means that if somebody misses the timing, due diligence needed to be released by 20 days and you're on day 22, the seller can cancel the contract if you're the buyer. Vice versa, if the seller is supposed to have documents, rent roll, T12, everything else within 7 days to the buyer, and it's day 9, the buyer can cancel the contract. Okay, that is imperative that you do not miss those timings.
Yeah, very, very key. On a side note, one thing I always do with the contracts, I always ask the attorney or the title company to circulate a list of critical dates at the beginning. And the reason I do that is you want to make sure all parties are on the same page. You don't want somebody thinking due diligence ended on December 5th and the other person thinks it ends December 6th. But sometimes those 24 hours can make a big difference. So keep that in mind. Okay, so what's your responsibility in the due diligence? Well, ultimately, it's going to fall on the buyer to uncover what they can, but you have to provide them with access to certain materials to do so. So you have to give them financials, an updated T12, updated rent roll, a capital improvement list. So aside from the buyer just using those, the lender's going to use those. Whether it's your lender if they're doing an assumption or their lender if they're getting new financing. You know, you've probably heard it said many times that the lenders ultimately really control these transactions. Make no doubt about it. Debt absolutely drives these markets. And if the lender doesn't get what they want, they simply won't approve it. And then your transaction will be dead. So as a seller, you want to make sure you're giving the buyer what they need to go out there and get the deal done. Lender docs. So if you have an assumption, you need to give them any loan agreements, any notes, any documents you have, because them and their counsel will have to have the opportunity to review them and then put in an assumption application with the lender. Engineering documents. So those could be site plans, they could be surveys, they could be any construction documents you have showing the way and design that the property was built. Leases. So most times a due diligence inspection is going to include a lease audit. If you have, you know, a very modernized property, all the leases are probably digitized, which does make it a heck of a lot easier. Most of the ones that I've done still have paper leases. So if they have paper leases, then you need to provide the buyer with those. They're probably going to have to come into the leasing office and spend some time going through the files. If you have a digital one, they probably upload it to a Dropbox or a OneDrive folder and you review it at your own leisure. Vendor contracts. So these can be important because sometimes the buyer has to assume these. Not always, but sometimes you can't break them. Typically, the ones that can't be broken are longer-term things like laundry room contracts or bulk cable and internet contracts. So those are usually going to go with the sale to the buyer. If you have a landscaping contract or a pest control contract, you know, most times those can be terminated if needed. And the way contracts are usually worded is that the buyer is going to have an opportunity to review those contracts and decide which ones they want to keep on or terminate. All of the documents required by the PSA. So one thing that's important is you need to review your PSA and make sure that you can actually provide what the buyer wants. So don't just sign it blindly. Like there's certain times I reviewed PSA and I said, no, I can't consent to that because we don't have that. And I'm not going to spend some crazy amount of money to go out there and find things we were never given in the first place. So you have to make sure of that because that could be a default in the contract. And as a seller or as either party, you don't want a default. On-site inspections. You're not going to do the inspections. That's not your role. But you need to provide the buyer with reasonable access to do their inspections. The way most contracts are written is they're going to have their own vendors or their own personnel. They're going to be responsible for anything they damage. If it's pre-existing, it's not their fault. But if they damage something, they have to repair it. And most times they're going to have to provide insurance from themselves or the vendors they're using to make sure that they can actually enter the site. Your job as a seller, you're going to have to coordinate with the broker and the management staff. Because if the buyer needs access on X date at Y time, you need to make sure they have access and that they can do it. So any additional access, you're also responsible for coordinating and making sure that they get it. The closing table. So nowadays, most of the closings you'll see are probably remote. In the old days, once upon a time, you see a lot of in-person closings, not so much in the commercial sector anymore. But it'll usually specify in the contract what it is. Tenant deposits. So those are usually security deposits. So with security deposits, what's going to happen is at the closing, you as the seller, you're either going to transfer those deposits to the buyer's property management company, or you're going to give them a credit on the settlement statement for that amount. And usually the contract will dictate which one of those options it is.
So one thing I would do is if I'm selling a property, prior to any documents being signed, I'm not sending anything to the buyer. If it is required that it is collected prior to the signature of documents, then if you're at the closing, you can either have a check for those security deposits. It's going to be on the HUD regardless, so you'll know what the amount is supposed to be. And the buyer and the seller both have to approve the HUD before you go to the closing table. But the other thing is, if it's required to be there and you're remote, then I will send those deposits via escrow and give it to the title company so that it is in the proceeds. And then they can extract it out from that. As I mentioned the other day, you've got to keep those deposits separate from the operating account.
Right. Very important. Keep that in mind, guys. You don't want to be commingling funds. That never works out well. Assignment of leases. So basically what you're doing as the seller is you're taking all the leases at the property and giving the buyer the right to take them over. That's going to be important because they're going to need that to be able to continue collecting rents and operating the property. So any engineering documents, you're probably not going to give anything at the closing table that you didn't previously have. But if you happen to come across some additional plans or site plans or an updated survey, then you can provide them with that information as needed. So most times after the closing actually completes, you're going to have your property manager meet somebody from the buyer's team there and give them all the keys and all the access that they're going to need. So it'll be a transition. And usually at that point, then they take over, but you need to make sure they actually have access to get those things. Wiring instructions are a very important piece. So most times the escrow agent is going to be sending out a lot of wire transfers on the day of closing, and they need to make sure that they have wire transfer instructions. If they don't have those, you're not getting paid. So keep that in mind, and they'll hold your funds until they get them, or they may send a check out. Distributions and timing. So the first thing you're going to do is give the investors an initial distribution with an explanation and report. Withholding for final operations expenses. So, we do it maybe a tad bit different. So we'll usually aim to pay all the final operating expenses first, and hold that distribution back for 2 to 3 weeks so we can have a substantial portion at that time. But there's different ways you can do it, so keep that in mind. Withholding for taxes, that's a big one. You could let people pay them at the individual level. Just understand if you do that, there is a liability if somebody doesn't pay it. And if you're doing a syndication and you have 20, 30, 40, 50 investors, rest assured, there will be people that don't pay it. So I would recommend you do it at the entity level, but that's more a personal decision. K1s. So those are going to come from your accountant at the time that your tax return is prepared. But it's your responsibility as the operator or the asset manager to distribute those to the appropriate parties. And I see we have a question in the chat box, but to make an arrangement with the deposits, such as granting a credit to the buyer, is not a misappropriation of funds, right? So the answer is it's not. It'll really depend on what the contract is written to say. So the reason it's not a misappropriation is because you're giving the buyer those funds. At that point, they're no longer in your possession. So it's up to them to decide what to do with them. They could misappropriate the funds. That's on them. But if you've given them the funds, then they should theoretically take those funds and place them in a separate security deposit account. But as long as you've given them the funds, then you're okay. Then it's on them to figure out what they need to be doing with them.
100% agree.
Okay, so then the management turnover. So coordinate with the new buyer, your property management team, and the buyer's property management team to be on site and ready to start the turnover as soon as the ink dries on the documents and the funds are confirmed. That's the important part. So that's absolutely true. Most times from experience, at least from my closings, I don't know if everybody's going this way, but they almost always go right at the end of the day. It usually works out that way. Whatever the wire transfer cutoff is, we usually make that by about 30 seconds. And so most times it winds up being the following day. But if you close early enough in the day where you can have the transition, then you certainly want to do that. We have a question from Tim. If taxes are paid at the entity level, then the individual investors, when they get their K1s, they don't have to pay taxes, correct? So the answer is, in most cases, you are correct. Correct. So what you would do is you would have to give your personal CPA, the K1 along with all of your other tax documents, and then they're going to review them and see what tax you've already paid to date and determine if any additional taxes due or if you do a refund. So the answer is it's not a black and white answer because at the individual level, it'll vary based on a lot of factors. But for that one specific investment, I would say, yes, you're correct. But let's say if they reside in that state and they've earned other income in that state from other things, it's possible they could still owe some tax. So that's a totally separate matter that's way above this session here, I'm sure. Okay, so then you want to distribute the proceeds as agreed. Thank your investors, rinse and repeat. So nothing makes investors happier than getting money. When you give them large chunks of money in a single event, it makes them happy. So you want to do that as often as you can. And then you can celebrate. Don't celebrate too hard because you want to go out and start finding the next deal at that point, but a little bit. You may as well enjoy it. So what are the action steps here? Well, first thing is find an asset manager, take them to lunch or dinner, and ask questions to build your skill set. The second is create a business plan and a project management plan as a fictitious case study to increase your skill set. So all these things are designed at expanding your skill set in this area. Keep that in mind. Build relationships with title companies, which can help for acquisition as well as disposition. I'll tell you another secret on the acquisition side. Title companies are usually well connected. Many times they know when deals are going awry before other people, so sometimes they can be a good resource to have on the acquisition side there. Get the strategic acquisition certification to hone your skills and give you the confidence to close your next deal. And I'm going to turn it over to David to wrap us up here.
I appreciate it, buddy. If you don't mind, and great job, by the way, go ahead and hit the enter key one more time to take me to the next slide. So you guys have seen this. We started this entire education session with the strategic acquisition system. The certification is the same process, only we have some other things built into it. So I'm not going to spend a lot of time on this. I just want to give you a idea of what the certification encompasses. So we start initially with beginning at the end in mind, just like we did, so that you get a clearly defined real estate investing entity with company name, email. Remember, we're also setting our goals, getting you to that monthly number. All right. So we actually have deliverables. The biggest thing with this strategic acquisition certification is it goes in 3 phases. So we start with acquisition. Okay. You begin with the end, finding opportunities, negotiations. There's a test at the end. You have to score an 80% or better to be able to move to analysis. But more importantly, each one of these, excuse me, and I'll explain what they are. There are practical applications that you have to do. So if your practical applications are complete, you score 80%, we move to phase 2. That's where we go through due diligence, property management, capital stack. Again, there will be an 80% or better exam at the end that you have to score and complete all of the practical application except the on-site due diligence, which I'll explain in a minute. Then you can move to operations, where we go through the next 3 steps, take another test at the end. And then once you've completed all your practical application from all 9 steps, then you can take the final exam, at which time you can get the certification. And I'll explain what that can do for you here in a second. So coming back up to begin at the end, we talked about this in detail in the acquisitions class in the beginning. It's setting up that owner entity and getting your goals and objectives set. So we're starting with the beginning at the end in mind. Then we go to finding opportunities. We talk about how to build opportunities for off market, how to build relationships with brokers and everybody else. This also includes underwriting and some initial market analysis, because if you're underwriting deals in a market, you need to know how to do an initial market analysis. All right. And the practical application on this one is that your lead generation and conversion system is built inside of Acquisition Pro. Now, with the certification, you get 1 year free access to Acquisition Pro and the strategic acquisition system that goes with it. So that comes with this certification, right? You also are going to be required to speak to at least 3 real estate brokers locally. All right. The reason for this is we want you to get used to communicating with brokers, and we want you to get used to touring properties. So we would like to see 3 opportunities brought your way. Doesn't matter what size they are in your market, whether you're investing in your market or not. Again, because we want you to get out of your office. We don't want you to spend any money and go into your market and tour properties pre-offer status. So it's much different touring before you purchase than it is during due diligence. And we'll cover all that in step 2 of phase 1. So that's the big deliverable for step 2. For step 3, where we clearly define a negotiation system to produce a win-win result, here your deliverable is you're going to submit an LOI. Now, great chance you probably don't want to buy the property. And if you do, wonderful, we'll even help with that. But if you don't want to purchase the property, we still want you to submit that LOI. So we'll explain exactly how to submit it, what to use, give you the template to do it, help you set it all up, how to communicate with the broker, let them know, look, this is just something where this is what our value is. We understand we're not going to be competitive, but we wanted to submit it anyway, and continue to build that relationship with you. And thank you for sending us the opportunity. One of the other things in step 2, if I back up for just a second, is when you receive the 3 opportunities that you're going to get after you tour the property and you tour the comps in the market, we're going to have you underwrite that deal. Of course, we'll show you how to do that. We'll help you underwrite it. And then we want you to create a summary of your underwriting, show us how you did it, send it to us for review. All right. So there's practical application with this. Once you've completed all your education and action steps here and have passed the test with an 80, you then go to due diligence. Now, this to me is the big one. And this is where my relationship with Charles and his business partner, Ryan Murphy, come in. Is Charles and Ryan have agreed to open their properties up. And I'll explain why this is a win-win for all of us, for the certification students, for me and for them, is they're going to open the property up and you'll conduct on site one of their properties as if you are acquiring the asset. So full due diligence package, inspecting all the units, looking at all the structure, doing the lease analysis, the tenant analysis, everything else, everything that's included on on-site due diligence, you'll do on one of those properties. Now, why would Charles allow us to do that? Because now Charles has the opportunity on a quarterly basis to tour one of his assets. He gets to see all the units. He gets to talk to residents. He gets to audit his property management company by looking at the leases and the tenant files and having conversations with maintenance and the residents, everything we do during due diligence. And now he can write up a summary and provide to his lender and to his insurance company, which makes him look like a genius. Because I guarantee you, there isn't a syndicator in the Southeast that has come up as a syndicator in the last 3 or 4 years that is doing that. And they'll look like gold, and they'll continue to build relationships with their lenders and their insurance companies. May even get a little bit of break on some basis on their rates on future deals, either insurance or lending because of that. So that's the big deliverable. Of course, you're going to go through the strategic analysis model. We're going to build out your checklist and do market analysis is the big part of it. Go through an entire learning of market analysis in step 4. Step 5, the big deliverable here, you've already seen a lot of the education for property management, how to operate the property. We're going to talk a lot about preventative maintenance in property management, but more importantly, we're going to have you communicate with 3 property management companies so you can start learning how to interview them. Of course, we'll help you do that and be with you so you understand that process. And then the capital stack, this is the whole capital stack deliverables here. You're talking to lenders. And you're starting to build out your communications for your passive investors if you're wanting to do syndication. If you're not wanting to do syndication, you do not have to do that. But at minimum, you've got to talk to lenders. So again, we take your brain farting. We take your lead generation and lead conversion, throw it in Acquisition Pro, and set it up for your passive investors like I explained it yesterday. Okay, so that is the practical app. You're going to talk to 3 lenders and build out your investor lead conversion system inside of Acquisition Pro. Once property management capital stack is done, again, you may not, either Charles doesn't have time or you don't have time initially to get that due diligence done. He's got properties, and you can correct me if I'm wrong, Charles, he's got properties in North Carolina, South Carolina, and Georgia. And then they have another property in Mississippi. Charles will be the coach on the properties on the East Coast. I'll be the coach on the property in Mississippi. Because of timing, we allow you to move to step 3 or phase 3 without doing the due diligence. You just can't take the final exam until that is done. The big deal here with asset management outside of the education is that Charles has agreed to allow the students to be on 3 asset management calls for his team. So you're just there as a fly on the wall so you can see how the communication is done between their assets within their team. And then you just coordinate to get that done once you get to that phase. For project management, we actually have you build out your business plan from the deals that you looked at in step 2, and then we will review and approve those. And then exiting the deal, your big deliverable here, this is kind of the easiest one, is getting your checklist completed to exit that opportunity. Now, as some of you have seen from yesterday, the due diligence checklist that I provides all that information already. We'll just look at it based on your business and modify it. So the last one is the easiest one to get through. Once you've done all your practical app, take your final exam for this phase, and then you take the final exam, and at that point, you will be issued a certificate. So why is this certificate important? If you want the ability to provide some kind of certification, we're calling it the strategic acquisition certification. There are syndication companies that we are starting to build relationships with, and Cash Flow Champs is continuing to try to find opportunities. So where this matters is you will have the opportunity to interview for a GP position with either Cash Flow Champs if they have an opportunity at that time, or one of our other syndication partners as we build them. All right. We are not going to make those introductions until that certification is complete. We believe that the certification can be completed in 6 months, and the program is for an entire year, because we're not just going to leave you hanging as soon as you get the certification. We want to continue to work with you all the way through the 12-month period. You have 12 months to complete the certification. If you do not complete it by the end of 12 months, then you will not get the certification. It just means that you're not willing to put that work in. All right. So if you would like to have a conversation with me about the strategic acquisition certification, then I have a web address. Let me see. Here we go. Let me send this to everyone where you can schedule a 30-minute consultation with me. Keep in mind, my calendar only goes out 7 days. So over the next 7 days, I've got some slots open. If you want to talk to me about it, let's have a conversation. I guarantee you this is not a $30,000 program. All right. It's just not. Let's have a conversation. Let's talk about it. See if this is a fit for you. And we'll be happy to get you in if that is the case. Mel, with Canadians, if you're willing to fly to one of the properties, then I'd say yes. But it's really important that you get that on-site due diligence. You can do everything else. And I can talk to Charles and Ryan and see if they'd be able to waive that part of it. But that kind of diminishes the certification a little bit if we allowed that to happen. So we really need people to do that on-site inspection. It's a huge deal. All right. So with that, Charles, if you hit the key for the next slide, let's open her up for Q&A. Don't everybody talk at once. I have found, Charles, that for whatever reason, they like to sit and listen to other people ask questions. More than open.
I have a question.
I think we're all trying to digest the information you just gave us. That was really good, by the way. Hey, quick question about property management during the reposition phase. Do you guys, Charles or David especially, have any thoughts one way or another on using a full service property management company's contracting team to do the work?
When you say a full service property management company's contracting team, you mean like an in-house staff?
Absolutely. Yeah, and I use the word full service loosely, of course, but that's the way that it is marketed a lot.
So the answer is, I can comment on this because we're actually doing it now. The property management company that we're using at our two most recent acquisitions, they do have what they refer to as a traveling maintenance crew. So the company itself is headquartered in Columbia, Missouri, but they basically have a crew of maintenance personnel that goes around from property to property throughout the country. So the answer is it can be more cost effective, which is good. That's actually part of the reason we're using them for certain things in our properties. The downside is with an arrangement like that, unless it's a company that's concentrated in a particular region and has staff readily available, it may take some time. So in our case, while the crew does do good work and they're more cost effective, they're traveling from state to state and city to city. So it may take you 4 weeks in advance to get them at the property. So that's more time that those units are sitting vacant. So you have to weigh with any company, you have to weigh the pros of the cost effectiveness versus the timing of the an execution of the work to see which one makes more sense.
So
in our case, it did make sense, because there was enough of a cost savings that even with the couple extra weeks of vacancy, it still made it worthwhile. But that may not be the case every time.
From my perspective, and I mentioned this in I believe it was day one when we were talking about hiring a property management company, or sorry, day two. The importance is that your project manager and your property manager are two different people. They can be the same entity, and you can have some cost savings, like Charles said, with them being the same entity. But you absolutely do not want, and trust me, I know this from experience, you do not want your property manager to also be the project manager, because they're going to be good at one or the other, not both. Okay. And you want one to focus on getting units ready, and you want the other to focus on leasing those units up. And they can be doing that simultaneously. They cannot do it simultaneously if it's just one person.
Right. Keep in mind, being an on-site manager is a full-time job in and of itself. I mean, if you're dealing with a 20-unit property, you know, maybe there could be enough time to do both. But if you're dealing with a 100-unit property, that's usually going to keep a person occupied well enough that they're not going to have time to also be a project manager. So, you know, you'll definitely want the right people filling those seats.
Perfect. Thank you.
Good question, Andrew.
I have a question for you, David. This may be more appropriate offline, but in 2021, I joined the strategic partnering. I took the For Life agreement.
Okay.
And I'm assuming that will enable or allow me to join tomorrow's session. And
Yes.
if that is the case, how can I be sure that I have access to it?
I sent an email to all strategic partnering members. It was either yesterday or Monday with the link to join for day 4.
Okay. Thank you so much. That was 2021, by the way.
I know you've been around a while. If you don't find the email, just send me an email and I'll send it to you.
Okay. Thank you.
Yep.
I have a quick question. First, I want to say thank you, David and Charles. This has been amazing. But you said that we want to be sure to cash flow. What is a good percentage? I was told 7%, but is that still what we should look for?
Charles, I'll let you answer that first, and then I'm sure I have a whole different perspective.
So the answer is, Haley, it's going to really depend on what you want out of it. So different people want different things out of an investment. Some people are happy with 4%. For me as a syndicator, I usually look for a minimum cash on cash return of 7% throughout the life of the investment, because that's what investors tend to want. Now, what I would personally say, and I'm just going to make an observation, and I'm sure you've probably heard me say this in some of the underwriting sessions, but looking at things honestly in current events, if I'm a person that has a savings account, which I'm going to guess that many of us do, and I'm earning 4% in my savings account today, 4% in a real estate deal does not sound attractive with the hope of earning 7 or 8 or 9% in years 2 and 3 and 4. So while I do think 7 to 8% is probably still an attractive cash on cash return, I think you need to have a higher cash on cash return right out of the gate if you're going to attract money, or you have to have an investor base that's willing to accept lower cash flow, and that just doesn't really care about that, because, you know, in order for people to justify the risk of investing in real estate versus pulling money from a savings account, they need to be making more money in that real estate investment to make it worthwhile.
Now, my perspective, and I agree with what Charles said. So it's all based on risk, Haley. But in today's market, in order for you to appropriately pay for a deal that is truly valued correctly, and a lot of them are not today, to know that you have appropriately paid for a property, you will be able to get 75% loan to value. A lender will give that to you. Don't listen to what they're telling you in the syndication world. Oh, it's risk, it's this, it's that. No, it's because their underwriting sucks.
Right.
So a lender will give you 75% LTV, but the trick is that on day 1, when you close the property, not 2, 3, 4 years from now and some pro forma, day 1, you have a debt service coverage ratio for that lender minimum. Could be anywhere from 1.2 to 1.4. If you're an office, ask George, it's 2.0. That's how risky office is right now for lenders. But for multifamily, it's still 1.2 to 1.4. On average, we see 1.25, 1.23. If you have a debt service coverage ratio of 125 or 130, which is 25% higher NOI than the debt service, you're going to have cash flow. And you're probably going to be somewhere between 7 and 9% cash on cash return, because you're at 75% LTV. So if you value your investments correctly and you do your underwriting correctly, it will all work out. And that is fundamental principle underwriting. And that's needed in today's market because the market is going down. NOIs are dropping. Occupancy is decreasing in most markets, which lowers the NOI. Expenses are still out of control, and rents have flatlined, in some cases declining. So NOIs are dropping. So you have to protect yourself based on that information. How do you do that? You do it by cash flowing the day you close with a debt service coverage ratio of at least the lender minimum. Does that answer your question?
Absolutely. Absolutely. Thank you, guys.
Who's next? Charles, did I mention how good you did?
Thank you, David. You're too kind.
So you guys know that was my presentation. I wrote it and I just handed it to Charles because he wanted to help for today. And I said, make changes if you want to make it your own. And he goes, no, looks good to me. And he did amazing.
I just assumed that was his presentation and that he'd be taking over the course tomorrow, David. So good job, Charles. Thank you.
Well, thank you. I have to admit, I'm not as swift with PowerPoint as I should be. So
He also does not have a professional teaching certification like I do.
very
So
true.
that helps. You know, just saying that helps. What other questions y'all have? While you have Charles, use and abuse him. I don't know if he's going to be here tomorrow or not.
I'm gonna just say thank you, Charles.
Well,
Excellent.
thank you. Appreciate you coming today.
Hey, Charles, good to see you. Typically, I see you on Saturdays, but good
Likewise,
to see and
Mario.
hear
Good
you
to see you
today.
too.
Yes, sir. I appreciate all the good content. I've actually already signed up for the consultation for it. I'm very curious about the whole certification. I don't know of anything that offers the level of detail and just it's concise information that you guys are looking to offer. So I'm curious to hear more about that. But I just appreciate you going into depth with the information today. It's more of a thank you than it is a question. And thank you too, David.
Thanks, Mario. Appreciate that. And I saw your appointment come in. It's confirmed. Hey, Charles, don't forget to put your link for the Saturday sessions in the chat.
Yeah, so let me add that in there, and I'll put it in before I forget. So I'm going to throw my link tree in there, and in there you'll see a link that says free weekly underwriting session. So for anybody who's not on that list, you can click on that one. It's the second one down, and that will allow you to register for it.
Right. At this point, I'm going to pause the recording, but we are not done. You guys can stay here for more Q&A.